Michael Saylor has made absolutely no secret of his grand ambition, right? He wants MicroStrategy to be the world's biggest company by market cap. And, well, that's a seriously bold, audacious goal for a legacy software company that honestly spent decades flying completely under the radar. But when you hold that sky-high ambition up to the staggering reality of their recent Q2 earnings report, you get one of the most fascinating contradictions in the financial world today. Welcome to This Explainer. Today, we're looking at the ultimate paradox of MicroStrategy. So is this stock a brilliant, once-in-a-generation, leveraged play on the future of digital assets, or is it a high-risk gamble just teetering on the verge of going completely bust? Okay, let's dive into this and figure out what's really going on behind the curtain.
To make sense of this, we're going to peel back the layers of their financials. Here's our roadmap for today. First, the strategy paradox. Second, unpacking the hard numbers. Third, the net Bitcoin defense. Fourth, dilution and raising cash. And we'll wrap it up with the bull versus bear verdict. All right, let's jump right into section 1, the strategy paradox. Because to really grasp the story here, we have to look at the immediate, glaring contradiction sitting at the very heart of their financial strategy. $8.2 billion. That was the net loss reported for the second quarter. And no, that's not a typo, and it certainly isn't just a minor corporate speed bump. That is a massive, dramatic financial hole. I mean, to put that into perspective for you, MicroStrategy's actual software business, the core product they technically sell, generates just a tiny fraction of that in annual revenue. Losing $8.2 billion in a single 3-month window is almost unfathomable for a company of this size. When a self-proclaimed Bitcoin treasury company bleeds red ink at a scale that literally eclipses the GDP of some small island nations, well, it demands our attention. We really have to ask, how on earth did they get here, and what exactly triggered such a catastrophic quarterly hit? Well, the answer lies in this incredibly specific number, 840,447. That's the exact number of Bitcoin that MicroStrategy holds on its corporate balance sheet. They didn't just stumble into this either. They actively purchased this massive stash at an average price of roughly $75,385 per coin. Now, here is why that is absolutely crucial. Because they own such a staggering percentage of the total global Bitcoin supply, they are inherently inextricably tied to the volatile swings of the crypto market. Every minor dip, every flash crash, every slight correction in the price of Bitcoin sends absolute shockwaves through their balance sheet. That devastating loss we just talked about, it's tied directly to the price fluctuations of this very specific, hyper-concentrated holding. They literally bet the farm on one asset. Moving on to section 2, unpacking the hard numbers. Let's see what this wild strategy actually looks like when you're forced to put it down on a standardized balance sheet. The sheer scale of the math here is pretty wild when you dig into the footnotes. The company paid over $63 billion in total to acquire their Bitcoin stockpile. But at current market prices, that stash is only worth about $54.8 billion. That creates an unrealized loss of over $8 billion. Now, what I found super fascinating is how corporate accounting rules handle this. In the traditional financial world, an unrealized loss, which basically means they haven't actually sold the Bitcoin yet, still has to be marked down on the books if the asset's value drops. That paper loss flows directly into their quarterly earnings report as a massive deficit. And the result of that little accounting mechanic? A devastatingly negative earnings per share of negative $99.16. By any traditional measure, looking purely at the income statement, this company is aggressively, spectacularly not profitable. The rules literally force them to bleed on paper every single time crypto has a bad quarter. This brilliantly illustrates the cognitive dissonance happening in the market right now. Just think about a tech giant like Apple, currently trading at roughly 8 times its sales, or NVIDIA, the absolute darling of the AI boom, trading at about 22 times its sales. Both of these companies are highly profitable, cash-generating machines, right? They're printing money quarter after quarter. And then you look at MicroStrategy. It's trading at a massive 63.5 times sales. That is nearly 3 times more expensive than NVIDIA on a price-to-sales basis, but with absolutely zero traditional profits to show for it. It kind of defies all known financial gravity. Traditional value investors look at a 63.5x multiple for a business hemorrhaging cash on paper and just assume it's a bubble waiting to burst. The disconnect here is just breathtaking. Naturally, though, the company is well aware of these criticisms. So, Section 3, the net Bitcoin defense. Let's look at how leadership justifies this massive premium to investors. When you look into how they attempt to change the narrative, you'll see they rely on a very specific custom metric called net Bitcoin per share. Instead of looking at traditional earnings or revenue multiples, they want you to look at this custom equation. Basically, it subtracts all senior claims, preferred stock, and convertible debt from their total Bitcoin holdings to show what they consider the true per share value. They're essentially saying, hey, ignore the accounting losses, ignore the software revenue. They want you to isolate the true unencumbered value of the Bitcoin that belongs solely to the common shareholders after all the creditors are hypothetically paid off. It's a completely different mental framework for valuing a public company. Let's visualize that math so we can actually understand the psychology of the investor here. When you carve out all that debt and those senior obligations, the remaining net Bitcoin value sits at roughly $95 per share. Now, keep in mind, the stock itself is currently trading right around $100. So when you view the company through this carefully curated lens, the market is pricing the stock at just a 1.05 times multiple of its net Bitcoin value. Through their eyes, that $100 stock price suddenly doesn't look like a wild 63x revenue premium at all, right? It looks like a perfectly reasonable, almost conservative multiple. It's a total shift in reality depending on which metric you trust. Honestly, it's a masterclass in shifting the financial paradigm. But, and this is a big but, there is a major catch, and it's absolutely critical for anyone trying to understand the risk profile here. Net Bitcoin is a liquidation value. It is not earnings. This custom metric doesn't generate actual cash flow. It doesn't pay your dividends, and it sure doesn't fund the daily operations of a software company. It represents what you would theoretically get if they halted everything, liquidated the entire treasury today, and paid off all their enormous debt. Which really begs a serious question. Are you buying a real operating cash flowing business? Or are you just buying a liquidation proxy with extra steps and corporate overhead? I mean, you can't pay employees' salaries with a theoretical net asset value. And that stark lack of cash flow brings us face to face with the pragmatic reality of running a business burdened by billions in debt. Section 4, dilution and raising cash. Let's see how they actually keep the lights on. Recently, we've seen a pretty major plot twist in their strategy. For years, the mantra from leadership was absolute, unyielding conviction. Never sell your Bitcoin. That was the battle cry. But recently, they quietly broke that rule. They sold 1,690 Bitcoin for about $108.6 million to repurchase preferred stock. On top of that, they sold roughly 6.59 million brand new shares of the company directly onto the market, raising $653 million in fresh cash. This whole flurry of maneuvering brings their total US dollar reserves up to a staggering $4.65 billion. They pragmatically broke their own cardinal rule to raise an enormous mountain of fiat currency. And in the crypto community, selling the asset you promised to hold forever, that is a massive deal. It definitely forces us to ask, why the sudden, desperate need for billions in cash? Well, it's all about liquidity and basic corporate survival. That $4.65 billion buys them a crucial safety net, over 2 years of runway to comfortably cover their heavy debt obligations. Specifically, they need this cash to pay the dividends and the ongoing interest on all that convertible debt they took out to buy the Bitcoin in the first place. But this survival tactic comes with a massive, unavoidable trade-off: dilution. By issuing millions of new shares into the market, they're spreading that same fixed amount of Bitcoin across a much larger number of shareholders. The result? Your individual slice of the Bitcoin pie actively gets smaller, just so the company can afford to keep the lights on and pay its interest bills. So, with all these moving parts, the massive volatile holdings, the heavy debt burden, the unyielding share dilution, where does this actually leave the stock? Section 5, the bull versus bear verdict. Despite all the very real structural risks we just walked through, Wall Street still sees incredible potential. While the current price hovers right around $100, analysts at Mizuho have set a cautiously bullish target of $165. That's a solid 65% upside. But the broader, optimistic consensus target, that sits way up at $301, literally nearly triple the current trading levels. This extreme optimism is driven entirely by the expectation of future massive Bitcoin rallies. The analysts in this camp believe that because MicroStrategy is essentially a leveraged bet on crypto, any surge in the underlying digital asset will catapult the stock price exponentially higher, making today's debt look like absolute pocket change in hindsight. So here's the ultimate standoff. The bull case is essentially an infinite money glitch, assuming Bitcoin hits staggering new all-time highs by 2027. If that happens, the net Bitcoin value rises exponentially. The debt they took on becomes easily manageable compared to their vast treasury wealth, and the stock re-rates even higher as the premier leveraged Bitcoin play on the global market. It's a glorious feedback loop of rising prices. But we really have to contrast that with the grim reality of the bear case. It outlines a potential death spiral. If Bitcoin simply stagnates or falls into a prolonged crypto winter, the company just keeps burning through its cash reserves to pay off that massive interest. The ongoing share dilution continues to silently bleed existing investors, and eventually, if they run out of runway and credit, that staggering $8 billion unrealized loss, it's forced to become a fatal realized loss. It is a high-wire act with no safety net below. Which leaves us with this final, truly provocative thought to consider. If you deeply believe in Bitcoin long-term, this company offers incredible, albeit highly volatile, leveraged exposure that you simply can't find anywhere else in the public markets. But it is certainly not a safe, traditional value investment. So I leave you with this question to ponder for your own portfolio. When you look at MicroStrategy, are you buying a true business? Or are you just buying a leveraged Bitcoin proxy? Can this company actually survive if the price of Bitcoin simply stops going up? Thank you so much for joining me for this explainer. Keep learning, keep questioning, and I'll catch you in the next one.